Hello there. Welcome to The Open right here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. Shares in Northern Dynasty Minerals are plunging in the pre-market. The U.S. Department of Justice is upholding a previously imposed veto on mining at the Vancouver-based company's gigantic Pebble deposit in Alaska. The miner says it prefers a settlement that withdraws the veto, but will continue to pursue the case aggressively. The company says the decision could be used as a precedent to block further U.S. resource projects. Final court briefs are scheduled for April. Warren Buffett's last move as CEO sees Berkshire Hathaway cut its stake in Apple, while picking up a new position in the New York Times. The conglomerate holding company cut its stake in Apple by just over 4%, while investing more than $350 million in the New York Times. Despite the cut, Apple remains the largest stock holding for Berkshire. And the Canadian housing market saw prices and sales continue to drop in the month of January. The benchmark home price fell by almost a full percent, now sitting at just over $665,000, the lowest level in almost 5 years. A senior economist with the Canadian Real Estate Board says cold weather could be the driving factor behind the drop in the latest period, rather than an actual decline in demand. And there's a look at U.S. futures. We've seen something of a rebound today. It looks like investor fears over possible massive overspending by AI companies are easing, but that's been weighing on the market lately. Let's have a look at TSX. TSX still down from its record high of last week. And checking in on oil, the Iranians expressing some optimism yesterday about progress in the talks with the U.S. over Tehran's nuclear program. And of course, ultimately, if a deal is reached, that could be bearish for oil if it releases more Iranian crude onto the world market. And let's see how gold is doing. It's been setting record after record. You can see it's up today, but still below that 5K benchmark. And checking in on the Canadian dollar, which has been rallying lately because of weakness in the US dollar. You can see it's off, though, a little bit today. And finally, Bitcoin, a good measure of optimism or lack of it in the crypto market, and it is under pressure yet again. Well, let's get more on the U.S. equity markets, in particular what our guest calls the possibility of a regime change in artificial intelligence and technology. He does argue that AI fundamentally alters the landscape for tech companies. We're joined by Tim Murray, capital markets strategist in the multi-asset division at T. Rowe Price. Tim, thank you very much for joining us.
Well, thank you for having me.
What do you mean by regime change in the tech market?
So I think it's important to understand we had 15 years where mega cap tech companies were fantastic investments. But there were two really important reasons for that. And they were basically that you had low capital intensity and you had low competition. So mega cap tech companies basically have dominated three industries. We had a disruption in three different industries. Those industries were media. So you had the switch from basically broadcast media to digital media, interactive media, on-demand media. You also had the switch from enterprise computing being kind of on-premises to now being in the cloud. And you also had the big switch in retail moving from brick and mortar to online. And three companies dominated, or sorry, not three companies, the mega cap tech companies dominated those three industries. And they did so without having to spend a ton of CapEx. And they also did so without competing a lot with each other. They kind of stayed in their own lanes, right? So first of all, the CapEx was kind of asset light, soft CapEx, it was mostly code, intellectual property, research and development. And then the competition, they were all kind of able to find their own lane. So, you had Facebook being the one that was dominating the digital media shift. You had Google dominating search. You had Amazon and Microsoft dominating that enterprise compute, the switch to the cloud. And then Amazon certainly dominating retail. So as a result of that, they had this great 10, 15-year period where they're growing revenues dramatically, really strongly, and they're also expanding margins constantly. And to see companies of their size do that for such a long period of time is just almost unheard of. But now we're getting to the point where, because of AI, those two dynamics are changing dramatically. So what I mean by that is you've got, first of all, the CapEx. We all know about how crazy the CapEx has been amongst the five big hyperscalers, right? They're no longer just doing code. It's also having to build these massive data centers and creating the massive power structures to power those data centers. And just to give you some numbers behind that, the five largest hyperscalers, they are projected to, between 26 and 27, spend $1.4 trillion on CapEx. And by the way, those are numbers that keep getting revised higher and higher. So tremendous amount of CapEx. And then meanwhile, you have them all kind of saying, we want to dominate AI, and not really willing to cede the competition. They all want to have the best LLM. And then on top of that, you have the situation where there's new entrants, right? So we've got probably three very big IPOs coming in the US market, one being OpenAI, another being Anthropic, and another being SpaceX, which just recently combined with xAI. So in addition to kind of them competing with each other more than they ever have, you now have new entrants with huge amounts of capital, a lot of private capital behind them, and they're about to get a big infusion of capital from the public market. So that means big change in the dynamics on both the capital intensity and the competition side.
And what would your take be, though? I mean, I know your overall feeling is that it's going to be much tougher for these tech giants to produce the same kind of gains in, say, the next 15 years. But broadly, how would you pick your tech stocks now?
Yeah, so I think what that means is that you need to recognize that it's just going to be a much tougher environment for these companies. The question, I think, we know these are great companies. And if you were to pick kind of who's the most likely winners, these are still the companies that are probably going to come out ahead of the game in AI and AI distribution in particular, if we look 5 years from now. The question is, how much pain are they going to kind of have to endure in the next 2 to 3 years? So I think from a standpoint of tech, I'd be concerned, especially if I'm not doing it with active management, if I'm just doing it passively, having a big slug, of my assets in tech, given that the biggest companies in the tech sphere are facing the toughest environment they've ever faced.
Right. I mean, they're off their highs, but still, those big tech stocks have I know they've suffered this year, particularly Amazon and Microsoft, but they still have been great investments.
Yeah, and also they've been, when we've seen a pullback in these stocks, buy the dip has been the way to go, right, for the last 10 to 15 years. And what I'm saying is that this time might be different, that it might not be as simple as buying the dip. Now, you can still see getting great returns over a 5-year period, over maybe even a 3-year period. But it's just over the near term, I think you want to be a lot more selective about your tech investing. And you probably don't want to just blindly have a massive allocation to tech versus the rest of the market.
And of course, we know that if you're buying an index fund, by default, you end up with a lot of tech. We're tight for time, Tim, but what areas of the market are you more interested in, or would you be overweighting right now?
Yeah, I would say the big three are industrials, materials, and energy. So not only because of the big AI build out, is there a lot of demand for energy, as well as materials and some select industrial areas. We're also finally seeing in the U.S., we're seeing a much broader broadening of the economy. So we're seeing much broader economic growth over the 2025 and late 2024. The U.S. economy was almost entirely just AI build out. Everything else was almost dormant. Now we're seeing we just got a PMI number that for the first time was above 50. First time, or only the third time in 39 months that it was above 50. And it was a big move all the way up to 52. Not only that, new orders went from 47 to 57. So there's a lot of reasons to say, okay, we're finally seeing that real uptick in the broader U.S. economy. So that's going to benefit industrials, materials, and energy on top of the AI tailwinds that you already have.
Yeah, it's interesting. And U.S. housing starts just hit a 5-month high, and that bodes well for material demand. Tim, thank you very much indeed.
My pleasure. Thank you.
Tim Murray, capital market strategist in the multi-asset division at T. Rowe Price. Coming up, Palo Alto, the security software giant, has cut its forecast, even though the second quarter was strong. That's ahead. The Prime Minister has confirmed that Canada has begun formal discussions with partners in the EU and several Pacific region nations, signaling early steps towards establishing an expanded multinational trading bloc. CTV's Mike LeCouture filed this report.
Prime Minister Mark Carney confirms Canada has begun discussions with countries from both the European Union and a collection of Pacific nations with an eye to making a larger trading bloc. It builds on his speech in Davos, where Carney called on middle powers to join together.
You start to put together blocks of like-minded countries on different issues. Canada can play a role there. We're one of the countries playing a role, and we'll continue those discussions.
The new trading bloc would represent 39 countries and 1.5 billion people. While the Conservatives applaud the effort, trade critic Adam Chambers says resources should be focused on renewing the Canada-US-Mexico trade agreement.
A discussion between CPTPP nations and the EU might have some future fruits down the road. We need to make sure that we get a deal right on NAFTA, as we did a number of years ago.
President Donald Trump has mused about walking away from the trilateral trade deal altogether. And some trade experts worry creating another massive trading bloc without the U.S. could make him angry.
We know Donald Trump. If you go down this road, he will take this as a personal affront. And we seem to be walking into the punches. I don't quite understand the strategy.
While there is a risk of blowback from the U.S., this former trade advisor to Prime Minister Stephen Harper believes getting like-minded nations on the same page is a good thing.
Even if this isn't successful, I think that there's still a worthwhile effort in having a common conversation with all of these countries together around how we can cooperate, how we can collaborate.
Trade experts also point out there are still elements of the Canada-EU free trade agreement which have not been ratified by European countries. So while there are discussions about a new trading bloc, we're still a long way from striking a deal.
The Open will be right back. Welcome back to the Open. We are hoping to get to those Palo Alto numbers shortly. They did beat in the latest quarter. However, they also produced a forecast that didn't delight investors. Okay, so we've had market turmoil unleashed by AI. People worried that it's going to hollow out the traditional software industry, and also that it won't fulfill very expensive promises, expensive in terms of massive capex to build out these data centers. Bloomberg Originals has more.
Wall Street is suddenly waking up to the fact that AI might impact a larger number of industries and faster than they had expected.
What this story is about is how AI disruption fear is leading to sell-offs in parts of the market outside technology. On Wall Street, rising fears about artificial intelligence, and specifically where it will disrupt certain companies, are sending shares of those companies tumbling.
Wall Street has done an about-face. Investors were concerned that AI was costing too much and might lead to a big bubble with untold harms. Now investors are concerned that AI is going to be so disruptive that it renders countless businesses obsolete. There's definitely been a spillover, starting with concerns about legal services, SaaS companies heading into insurance firms, tax preparation services, financial services, each of these in reaction to incremental AI products. The market sell-off really started in early February when Anthropic introduced a plugin to an existing product, one that they did not even really do a formal announcement for.
So what we saw on February 10th, for example, was shares of wealth management companies sell off after Altruist, which is a little-known AI startup, came out with a new tax strategy tool. Look at the stock slides of companies like Salesforce, Charles Schwab, and Blue Owl. Investors are concerned that AI might be able to replicate their offerings soon. The fear for investors right now is that they're going to get caught up in the next version of this sell-off, and so they're really looking for ways to avoid that.
Let's take a step back. In November of 2022, OpenAI kicked off the AI boom. When ChatGPT launched, people were mainly using it to spit out clever song lyrics and poems and pithy responses to things. But what we've seen in the last year or so is that people have been using these to shop for products online, do more advanced online research, and even build apps from scratch with little expertise. Wall Street now seems to be waking up to the fact that those same tools can be used across different sectors.
These tools are coming out and they're good. And so what we're seeing is investors really worried about the parts of the market that are tied to AI risk and looking instead to go more into the AI winners. This chart depicts two baskets of US listed stocks from UBS research analysts. One is AI winners and one is AI risks. So you can see there's been a massive divergence as investors look to avoid companies associated with these risks and flock towards the AI winners.
That technology has been very disruptive in a certain corner of the world, particularly Silicon Valley. But in recent months, it feels like there's been a mainstreaming of it, where we're seeing broader awareness, right? You can use that same technology in your everyday life or in other sectors, even if you don't really want to code.
We've seen video game stocks get hit after a new Google Gemini launch. We saw insurers get hit after a startup came out with a new product. And even more recently, real estate stocks are selling off as investors think that this could be the next place that's going to get hit.
At the moment, Wall Street seems to be whipsawing between two different, extremely opposing views. There are investors who are concerned that tech companies are spending too much money to build AI services with an uncertain payoff. On the other side, investors are anxious that AI will be so disruptive that it renders numerous businesses obsolete.
I've definitely heard sources say that they just don't understand how both of these things can be true at once. They don't think that these knee-jerk reactions would be happening if we weren't near record highs on the S&P. We don't know what next feature or new product is going to be released that sets off the next sell-off, so really we're just watching to see what happens next.
Unsurprisingly, it's hard to predict where things go from here. What's clear is that the large AI developers and a long list of AI startups plan to bring advances to more and more sectors as they try to make money from this technology. So we should expect that if Wall Street is now worried about how disruptive AI could be, there will be plenty more moments in the months ahead for them to be concerned.
And actually, the Financial Times of London today has a story saying that there's a backlash in the MAGA heartlands against Trump's aggressive promotion of AI. People don't like the big data centers taking up their water, potentially pushing up power prices. And some people are concerned that kids are being pushed into a dream world out of reality by these powerful AI tools. The Facebook founder, Mark Zuckerberg, is expected to testify today in a Los Angeles courtroom. The trial is over whether social media companies have been deliberately getting children addicted to their apps. ABC has a preview with this report.
This morning, Mark Zuckerberg set to take the witness stand. The man in charge of Facebook and Instagram will face questions under oath about whether his social media platform deliberately targets children with addictive design features. A 20-year-old woman who's also suing YouTube claims the apps hooked her with features like instant notifications, autoplay, and infinite scrolling, which she claims caused her depression and suicidal thoughts. She began using social media at the age of 6. Some legal analysts say jurors may have a tough time buying her argument.
They're pointing at KGM, that's the name for the 19-year-old who's the plaintiff in this case. They're pointing at KGM and saying, yes, there could be some negative things about social media, but let's talk about her. There was already issues with her, and that's what caused a lot of the mental and physical issues that she's arguing with, not social media.
Defense attorneys are trying to prove the plaintiff had mental health struggles before using their apps, and they say the companies have invested in safeguards and new policies to protect children. An Instagram executive testified last week that keeping teens safe is in the company's financial interest, saying, quote, "It's really hard to imagine any instance where prioritizing safety isn't good for revenue." This will be Zuckerberg's first testimony in court on the potential dangers of social media.
I think that there are harms that we need to work to mitigate.
He's previously testified before Congress in 2024 when he addressed parents who said their children were exploited or harmed online.
TikTok and Snapchat were also sued in this case, but already settled. The trial is expected to last through March and could determine how hundreds of similar lawsuits play out. Nicole D'Antonio, ABC News, Washington.
Let's check out the U.S. futures as we count down to the opening bells. And it looks like we are going to get a marginally higher open for U.S. stocks today, but that's after selling this year and over the past couple of weeks, with investors losing faith in some of these big tech names. And remember, we heard off the top of the show from Tim Murray of T. Rowe Price that for years, these companies like Google and Amazon were reasonably asset light. I know Amazon had to spend heavily on warehouses, but physical plant wasn't a huge drag on companies such as Meta, for example. But now that's changed with these hundreds of billions of dollars being spent on data centers to try to keep up with the demands of AI. One stock we are watching is IAMGOLD. Of course, it's been sweet to own gold stocks lately. Look at that. The stock up threefold and more in a year. The company reported after the bell yesterday. We've got those opening bells next. There we have it, the opening bells on Bay Street and Wall Street. At the NASDAQ, QuantumScape is ringing the bell. At the New York Stock Exchange, we've got Inflection celebrating its initial listing. And at the TSX, it's the 2026 TSX Venture 5 companies opening the market to celebrate their ranking. Time for the first 15. And let's check in on the equity markets as we get going on this Wednesday morning. And we are seeing some strength in the big U.S. tech stocks. It's helping to push up the indices on both sides of the border. You can see the TSX advancing more than 0.5%. Not much of a gain for the U.S. market, only about 0.1%, but a lot of investors will take it after the tough time, particularly the tech stocks have had over the past couple of weeks. Massive trading volume to kick us off in NVIDIA and Apple. Let's have a look now at some stocks of interest. We'll kick off here with IAMGOLD. IAMGOLD coming out with its Q4 financial results and the stock advancing. National Bank says strong free cash flow generation here. Hardly surprising with gold around $5,000 advances shareholder returns. There was a tide of cash flow, free cash flow of $580 million. And that was above National Bank's estimate of less than 540, and quite the jump from Q3, which was less than 200 million. So these gold companies are a bit like the Colombian cartels in the good old days. They had to weigh their money. It took too long to count it. Let's have a look at TFI, the trucking company, and that stock under a little bit of pressure here. Desjardins says, sure, there was a Q4 beat, but that was overshadowed by a weak forecast for Q1 earnings. So they came out with a guidance of between 50 and 60 cents US a share. That was way below consensus, according to Desjardins, of 81 cents. Okay, but that's interesting. Desjardins said, we had thought we'd get a neutral reaction because we thought whisper expectations had already dropped below consensus, but you can see a little bit of disappointment in those numbers. And finally, Riocan. Let's have a look here. Cash flow per unit beating expectations, stock off a little bit. And the occupancy still pretty strong, 97.8%, slightly ahead of the estimate of 97.3% for the retail real estate giant. Let's get some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader at the Bloomberg News Equities team. Wouldn't that be nice, Jeff, to be able to, you have to weigh your money. You can't be bothered.
I mean, you would invest in very nice scales if you did, right?
That's right. Palo Alto under pressure. Of course, everybody wants cybersecurity, but the forecast not delighting investors.
That's right. The stock is selling off this morning, and it's the worst performing stock in the S&P 500 so far. Down as much as 7.8% in the pre-market session. Definitely one to watch over the course of the trading day here. They did give a tepid guidance on their earnings. Now, it's a bit of a mixed bag because the earnings forecast is a little bit less than what what Wall Street consensus had, while the revenue is a little bit more than what consensus had. So the way RBC put it is that the revenue looks is beating and it looks good, but the profitability it came down across the board here. This has spurred a handful of price target cuts. JP Morgan, Jefferies, not RBC, as well as D.A. Davidson, Stifel, Susquehanna, Needham Securities. So there's a lot of analysts weighing in this morning on that kind of more tepid earnings outlook for this company, and cutting the price targets as a result. So now we're seeing the stock fall under a lot of pressure as people are scrutinizing these earnings.
And Moderna saw some strength. The U.S. regulators accepting a flu shot for review.
That's right. So this is one we're kind of coming full circle. We talked last week about how Moderna shares were under a lot of pressure. They sold off very sharply last week when they got a surprise from the U.S. FDA that the FDA would not be reviewing their flu shot. And the stock dropped. It was the worst performing stock that day. It's not the best performing stock in the S&P 500 so far today, but it is getting a lift because it does look like the U.S. Food and Drug Administration is reversing course on that prior decision not to review this flu shot. They are going ahead with it. Maybe a little bit of a headwind has been removed from this stock, and they are getting a lift so far this morning. Pretty big jump so far, actually, 8.2%. That's going to be one that is worth watching over the trading day here, as it looks like that surprise negative announcement from last week has now been reversed.
You know, that's reminding me I got to get my flu shot and my COVID shot. I can't believe it. I just have been procrastinating on that one. So thanks for the reminder. That's Jeff Morgan of Bloomberg. Can we maybe put up a stock here, Capstone Copper, because investors not loving the news from this company. They are getting a downgrade at Desjardins. What's today? February 17th? Yep. This is the 18th. Well, this was yesterday anyway. And there is the stock down 10% almost today. Yesterday, Bryce Adams of Desjardins downgraded the stock, saying the guidance from the company had been disappointing, and there an actual improvement or turning point at production and costs of their Monteverde mine seems to be deferred right out to 2027. So Capstone Copper out of favor with investors right now. Okay, we've had a whole bunch of earnings, and we're going to drill into those. We heard from Ryokan, Gibson Energy, and Palo Alto Networks. Are any worth investing in right now? We'll have more after the break. Okay, let's get more on the markets. But first, a reminder about yesterday on Market Call. We were joined by the one and only Rebecca Telcher, portfolio manager at New Haven Asset Management. And she provided insights on Canadian dividend stocks. Her top selections, ARC Resources, Emera, and TELUS. And today on the show, it's Michael Hakes, senior portfolio manager at Murray Wealth Group. And he'll be taking your questions on U.S. and global stocks. Okay, we have another expert from Murray Wealth joining us right now. It is earnings season. Software, of course, has been under pressure, amid fears that AI will erode margins there. We'll be able to vibe code our own programs. We've seen some resilience, though, in real estate and energy. Let's have a look at earnings from some of the big players. We're joined by Jamie Murray, president of the Murray Wealth Group. Jamie, thanks very much indeed for joining us.
Thanks for having me.
Give us your take on Palo Alto Networks. Investors not delighted today with the company's forecast, it looks like.
No, exactly. I mean, as you alluded to, the whole entire software ecosystem's been under pressure the last month. And I think any earnings misses are just being questioned, and we're seeing stocks sold off hard on any questions about future growth. And so, I mean, Palo Alto, the big miss there was on the margin side for 2026. The actual earnings this quarter were fine, but of course, when you're worried about future disruption, it's not what's happening today or yesterday, it's what's going to happen tomorrow. And so Palo Alto, the margins were a little bit light. It's also a bit of a back end ramp to their growth rates, and that's another thing that just generally investors don't like to see is these back end, second half of the year. That's when we're going to see the acceleration in our revenue. So that's what Palo Alto was saying. That's why the stock's down. It's not one that we own, but I mean, certainly the software complex, if you're looking for an entry point, now these are the sell-offs you're looking for to buy these type of names.
I mean, Palo Alto is so big. I suppose a lot of IT managers and companies think, well, I won't get fired for hiring them.
Yeah, exactly. They really have a platform strategy. So you have the Palo Alto platform. They bolt on acquisition. So anytime there's a new cybersecurity threat, which it seems like every week and every month there's a new one, they bolt on additional capabilities. So it's really a platform of tools. And to your point, exactly, it's one of the leaders and one of the go-tos in the industry. They still have very strong growth, but it's not a cheap stock. So I mean, it still trades at I think a 40 times PE rate, even after the sell-off we've seen in the last 6 months. So you are buying that future growth. And, I guess that's not a name that we currently own, but it's definitely getting back into the range where I think the growth at reasonable price investors who are willing to pay a bit of a premium for a great growth story is going to start to take a look at it.
The Ryokan, what about them? Let's maybe put up a 10-year chart for Ryokan. Obviously retail has been turned inside out by the advent of online shopping. There's a 10-year chart, thanks control room. Look how it collapsed in the pandemic, came back, but it's been kind of soft after that bounce back in the 2 years following the dark years of COVID.
Yeah, so I'm glad you put up the 10-year chart because it really does show over the history. Ryokan has not been a great performer. The COVID sell-off, then in 2022, we had interest rates move up higher, which means every real estate company had to reprice their asset base and their debt stack at higher interest rates. And then 2025, we saw the HBC bankruptcy, which is just a huge amount of retail space in Canada come to market. But despite all those, we're still seeing the stock start to push higher. And we actually really like REITs in general in Canada. I mean, you have to be selective, and retail is an area that we think is pretty attractive right now. And so, I mean, in RioCan's results last night, they talked about 20% uplifts or greater on renewing leases. So that's a positive indicator for future funds flow growth. The amounts of space available, I think they're at 98.5% committed occupancy. That's right up near records. And generally, the retail market, despite all these headwinds over the last decade, seems like it's in pretty good shape right now. We're seeing some strong retailers like the grocers, the Walmarts, the TJXs of the world start to take up some of these spaces. And, I think the whole sector is sitting pretty right now. We don't own RioCan, but we actually bought just a couple of weeks ago Primaris REIT, which is a malls-based retailer here in Canada and really benefiting from the same trends.
Primaris REIT. I can't remember the symbol on that one, but
it's PMZ.
PMZ?
PMZ, yeah.
Okay, and thanks. Maybe we'll have a look at that. What kind of retail do they specialize in? Can you remind us?
Yeah, so they, like RioCan is more of those general big plazas. Primaris is focused on enclosed malls, and they focus on some of the B and C mall assets, which on a standalone basis aren't great assets, but a lot of these are in, smaller cities, the Sudburys, Winnipegs of the world, and they really are sort of the neighborhood shopping destination. So they may not have the Class A brands that, Yorkdale Mall here in Toronto might have, but they still have a good foot traffic, and recognizing that we're not buying the top of the market assets. Primaris keeps a very low debt ratio, and their payout ratio is very low. So it's a 5% yield, but a very low payout ratio, very low debt, and they're looking to add new malls, new properties via acquisition, and with the thought that if we have a diversified property base, that will lower the risk of the whole portfolio.
And maybe we could pop up a 10-year chart for Power Corporation, because for years this was kind of a laggard financial stock, and then it won back investors, and they have a new CEO.
Yeah, so Power Corp and IGM Financial, the parent company of Investors Group, which Power Corp owns a huge stake in, both having phenomenal years. We're seeing the financials in Canada in general have a strong run. And yeah, we're seeing some natural, I think, succession through the Power Corp group of companies. The CEO of IGM is moving up to take over Power Corp, and the CEO of Investors Group is moving to the IGM helm, which also owns Mackenzie, a big mutual fund company. And yeah, I mean, I think it's just, this is the type of executive transformation investors like to see, where it's very well timed. The street's very comfortable with all the executives into the seats they're moving. It doesn't seem like there's any, bad things under the hood. It's just a natural progression, and it's very well telegraphed. So this is how companies should look at their, executive appointments going forward. And we think, the street's going to be very comfortable with all the new executives in the Power Corp family.
Right. So Jeffrey Orr becomes vice chair of corporation, and then he was CEO. He's going to be succeeded by James O'Sullivan, who's currently CEO of IGM Financial. Right.
Yeah, and then Damon Murchison is going to take over as IGM.
Oh, at IGM. Thanks very much. Okay. Well, listen, Jamie, great talking to you. Thanks a million. Jamie Murray, president of the Murray Wealth Group. Just ahead, we heard from the boss of Wheaton Precious Metals on that gigantic, enormous streaming deal, silver deal, signed with BHP. And at least two analysts saying it looks pricey at north of $4 billion US. We'll have more after the break. So Wheaton Precious Metals is paying $4.3 billion US to get yet more of the silver from the Antamina mine in Peru. They already have dibs on Glencore's silver from that project. We were joined earlier by Randy Smallwood, CEO of Wheaton Precious Metals.
it's been the strongest performing single asset in our portfolio. We've seen 17% more metal than what we expected on the original acquisition. So it is one of the reasons that we're so excited about being able to double down on this one. BHP's share is equal to Glencore's. It's only a slight difference. The payability for BHP's share is 90%, whereas for Glencore it's 100. But essentially, it is a full double down in terms of silver. So really, becomes our second biggest asset within Wheaton, and quite excited to have such a quality asset at that level.
After the huge Salobo mine in Brazil, the Vale mine. Now, I read, and this is prior to this deal, I think it was a couple of weeks ago, that at current spot prices then, and silver has come off its highs, silver on paper was accounting for about 70% of your revenue. Now, I know that's a moving target, but does that sound plausible? Could silver have got that high as a percent of your total revenue?
No, last year, with the guidance a year ago, silver was about 35% of our revenue.
Okay.
With the updated numbers, we were getting close to 50, and with this add-on, we're probably about 55, 56% of our revenue right now. I guess when silver peaked at $115 here just recently, it might have been a bump higher than that 56%. But
right.
But yeah, your comment on Silver Wheaton at the start of this is we're starting to get a little bit more of a silver shine to us, aren't we?
Yeah, because years ago you started, your basic plan was, you guys, silver doesn't get valued in a company like BHP, so we'll go in and we'll buy the silver, and our paper will get a much higher valuation in the market.
Yeah, we spent the first 10 years in this company looking for silver streams. And so it's only over the last 11 or 12 years that we started focusing on all precious metals, and we've done very well on the gold side. One of the challenges is looking for opportunities in the silver space. And so when something like Antamina comes along and BHP has huge capital needs, they're growing in so many different places and need the capital. You just make sure that you are set up so that you can take advantage of these opportunities. So yeah, it's tough to find good silver production, especially such high margin silver production, and pretty excited to bring this one in.
TD have a buy on your stock, but they do say that the initial deal returns look low on our production assumptions and spot silver. However, of course, the beauty of your model is that as the mine expands, you get more silver. They're calculating a pre-tax internal rate of return of only about 2.1% based on spot silver of $76 US an ounce. However, there's different ways of calculating. There's multiple different ways of calculating it. But are you going to rely on expanded production at this mine to really make it work, Randy?
Yeah, it's one of the challenges. It's not really a challenge. It's just the approach. It's the operating approach of the consortium that runs Antamina. Is to reserves must have tailings capacity. It must have all the infrastructure capacity, and so the measured and indicated resources are definitely of high confidence in our eyes. The inferred resources, again, excellent continuity and great grades. It is one of the highest margin copper mines in the world, and zinc. It produces both healthy copper and zinc production, but all at a very, very low cost. And so all the exploration potential, all the inferred resources and the exploration potential, we're comfortable that this is a multi-generational asset. They've never had a problem replacing reserves. The asset's now in its 26th year of operating, or 25th year of operating, and it looks stronger than ever. The land package, that's what particularly excites me. The land package itself has even grown from when we did the original Glencore transaction. I think it's about a 20% increase in covered lands within our area of interest. And so it's a life of mine deal, which means that we'll get our share of this silver for as long as this operation runs. And that's, as I said, we look at this as a multi-generational asset.
The silver, you're bullish. I mean, obviously, you're bullish on silver. Let's have a look at silver over the past 1 year. It is off its highs. What price would you start getting concerned about this particular deal? Like, silver is around 73 today. What price would you start getting? Oh, gosh, would you start wondering, gosh, should I have paid $4.3 billion US there?
Well, again, it's multi-generational, right?
Yeah.
And so our business is to provide our shareholders access to high quality precious metals production for good long life assets, high margin assets. And this asset, first quartile, and good long life, long expiration potential and all that. So if you ask me what I think the price of silver, silver is a very volatile metal. Trust me, having been focused on silver for the first 10 years, it's got very high beta.
Yes.
And so, I don't get too concerned about the ups and downs. What I look at is the overall trend. And there's just so many factors that support that overall trend. That vector is still pointing up and stronger. And we are going to see some volatility as, peace breaks out around the world, such like that. You're going to see that, but I'm just not confident in that being able to stick around long term. I'm hopeful, but not confident in that. And so I think there's two factors. One of the reasons I am bullish on silver is it's going to get pulled with gold. Gold is no doubt the main store of value, the main reserve commodity / reserve currency, and I am very bullish on gold long term. Silver gets that same benefit. It gets pulled along with gold, and so I have no doubt that there's that strength. But silver is also, I call it the most critical of minerals, because everywhere we use it in industrial applications, it makes the world better. It means we use less energy. It conducts electricity better. It has less resistivity. It means your batteries last longer. You get higher processing power. And so in this age of mobility and AI, silver is going to play an ever-increasing role to try and develop. I sit and think about where we're going with respect to AI and the processing power that's required, the demand for silver to try and give that processing power so you can have efficient AI systems in place. I don't think that's going away. Well, I just know it's going to continue growing. And so we're excited about silver, both from the industrial side and also from the precious metal store of value side. We just think it's a great place to be investing.
And Randy, just remind us, when do you step down as CEO and become chairman?
The end of March. March 31st is my last day as the CEO, and the team is just stepping right up. Haitham Hodley will be standing in as the new CEO. I've known Haitham for over 20 years. It took me about 5 years to convince him to come and join me here about 14 years ago, and he's been an excellent partner of mine, and I'm so excited for him and the rest of the team. So, like I said, they're sure doing a good job making my last few weeks here exciting.
Randy Smallwood, the outgoing CEO of Wheaton Precious Metals. Let's have a quick look at the stock over the past week, maybe. I'm just looking at Stifel's analysis here. It looks like the market happy enough. Stifel, though, says, we think the street will focus on the high price tag and the skinny internal rate of return. So as Randy Smallwood said, that's our job, give people exposure to precious metals. But of course, time will tell whether his bet on silver here, and it is a big one, the biggest streaming deal in history, was over optimistic. Up next, we'll find out if the latest read on the Canadian economy will move the dial for the Bank of Canada when it comes to interest rates. Carl Shimada is up after the break. Welcome to the second hour of our show here. The big stories we're bringing you from our newsroom. Shares in Northern Dynasty Minerals plunging today. The U.S. Department of Justice is upholding a previously imposed veto on mining at the company's huge pebble deposit in Alaska. Now, they've been pushing that for years, but opponents have said it jeopardizes crucial salmon rivers in the U.S. state. And it's been a long time battle trying to get that one ahead. GM Canada is investing an additional $63 million in its Oshawa assembly plant. And the move is for next generation full-size truck production. And it'll upgrade operations and enhance the service parts business. This brings GM's total investment in Oshawa to $1.5 billion. That plant currently builds Chevrolet Silverado light and heavy-duty full-size pickups and it is GM's only North American facility producing both models on the same line. Japan plans to invest up to $36 billion US in American oil, gas, and critical mineral projects. It's the first set of its $550 billion US commitment under a trade agreement struck with Washington. Those investments include a natural gas facility in Ohio, where Japan is expected to invest up to $33 billion. The announcement comes just before the Japanese Prime Minister is set to meet with US President Donald Trump in Washington. And there's a look at the TSX, up in morning trading so far, and still down from record high, the record high of last week, last time I checked, but certainly gaining today. And we did see strength in the open in US stocks as well. Yeah, we're still down from the record high close of 32,256 last Tuesday of last week, I mean. But we are above 33,000 for the TSX. And there's a look at the US markets. Let me just check what's trading right now. Some of those mag stocks have been major disappointments this year. Nvidia is higher in early trading, tops the trading list. The value volume by value. It's up $3. SanDisk is down. That's been a darling, of course, because there's been a shortage of memory components with all this investment in AI. Tesla is narrowly ahead. And Palantir, the somewhat sinister software company, jumping 4%. Let's have a look at oil now, see how crude is faring. Crude is hanging in. It's up about 3%. Headline on Bloomberg, Russia cuts oil drilling as money dries up and output is at risk. And let's have a look at gold, see how it's faring. And gold getting its snout above that $5,000 level. And we are, it's amazing really. Gold yesterday struggled because of thin holiday trading in Asia. They're celebrating the Chinese New Year, but gold up today. And let's have a look at the Canadian dollar, see how it's faring. And the Canadian dollar down slightly, but holding north of 73 cents US. And finally, Bitcoin. Bitcoin has been an unhappy story for investors for quite a while. There have been dire warnings of a possible self-reinforced selling wave if some of these companies that hold a lot of Bitcoin are forced to dump it into the market. But interesting, of course, that Bitcoin attracted vast amounts of money, or ETFs, vast amounts of money went into Bitcoin ETFs, and now there's been huge outflows. So those ETFs can be a double-edged sword. Okay, Canada's inflation rate edging down in January. Does this give the Bank of Canada an opening to cut rates yet again? Let's get perspective from Carl Shamata, Chief Market Strategist at Corpay. Carl, thanks very much indeed. I guess
Great to see you.
Tiff Macklem has been at pains to say, look, I can't do much about trade wars.
That's right. I think, he's very clearly articulated the need and the motivation for staying on hold for a prolonged period of time here. And markets have, definitely taken his words to heart. When we look at overnight index swap pricing, it is showing no movement in Canadian policy rates through to the early part of 2027. So, it's definitely a bank that wants to sit on the sidelines and does not see a good reason for moving in either direction right now.
I guess one reason he'd want to avoid cuts for now, he wants to keep his powder dry in case the economy really goes into a tailspin.
That's right. They are definitely monitoring downside risks when it comes to, the trade relations with the U.S., when it comes to broader, business investment and consumer spending and, with respect to the housing market. But, I think the basic prognosis at this point is that if they don't touch the pedal for now, the economy should come through this with, minimal damage and grow at a relatively gradual pace without sparking a new wave of inflation anytime soon. And so, it does make sense at this point to stay in neutral and avoid and preserve as much optionality as they can on either side of the rate cycle.
We're seeing signs that investors are cautiously moving back into tech stocks today, but the sell-off over, this year has been pretty violent for some of these big names.
Yes, across financial markets, really, we've seen, a move away from those sort of speculatively driven, overheated asset classes back toward, a more defensive posture. And we look at, everything from currencies through to precious metals to commodities, equity markets everywhere. We're seeing that sort of dynamic, and it does make sense. We clearly overextended in the late autumn through the early part of the year, and it does make sense for some rebalancing, some mean reversion to take place here. The reality is that we can't continue to go to the moon in a lot of these asset classes with no sort of relation to fundamentals. And so the faster that we take off some of that speculative excess, the more likely it is that we avoid a wreck down the road here.
It is interesting. I'm just looking at NVIDIA. NVIDIA is still up about 35% in a year, and Alphabet's still up 64%. So people have made a lot of money on these big tech stocks.
Oh yeah, and an overall household wealth and the overall value of stock portfolios is up dramatically, really over the last 5 years. If we look at the post-pandemic period, we've created trillions in wealth, at least on paper, and that's driving a lot of economic effects downstream, right? And so, I do think that at some point gravity has to reassert itself, but if we can kind of hold at these levels and let economic fundamentals catch up, then that is a more healthy, outcome than continuing to sort of pour additional money into the boom.
It's interesting. I referred to this earlier. The Financial Times talking about a backlash in the MAGA heartland against this AI boom. And one grandma in Missouri quoted as saying, "I have grandchildren. It does concern me that they're being drawn into a world that isn't real."
Yes. It's interesting if you look at the whole world from a broader context, from a societal and social context, as well as the technology that's being used. It is clear that we're moving into an intangible world, where the relation to what people used to consider real is pretty tenuous, and so. I think that's sort of interesting on two levels. One level, it does mean that we're probably getting overly detached from physical fundamentals that still matter. It still matters where we take, precious metals and base metals out of the ground. It still matters, how we power things and where commodities come from. So there's an opportunity there. But there's also an opportunity in the fact that, the value creation in the economy is increasingly moving into this sort of digital space that is not or that is unhinged from where we have been in the past. And so I think this is a real challenge for investors and for, policymakers to really grapple with is where is value going to come from in the future? What are people going to find useful? And where is wealth creation going to happen, right? The reality is if we look at younger generations right now in the world that they're in, what they think is important relative to what older folks think is important is very, very different.
Give us your thoughts on the US dollar. I mean, if somebody came to you and said, look, I'm thinking of shorting the US dollar over the next year, what would your response be?
I would say don't do it. That's always a dangerous strategy. Trying to predict foreign exchange rates is very, very difficult, firstly. But secondly, the issue is that when we look at measures of positioning, whether we're looking at investor positioning in the futures markets, if we're looking at options pricing or option skews, or we're looking at fund manager surveys, they're all overwhelmingly bearish on the dollar. And so to me, that's a contrarian sign. That's a sign that that investors are in a lopsided position and unprepared for a set of outcomes in which perhaps the U.S. economy outperforms against expectations. Perhaps we see an acceleration in growth in the coming months and a hawkish repricing in Fed expectations. If we were to see that play out, the U.S. dollar could very well recover against most of its major counterparts and wipe you out if you're in a leveraged short position.
Carl, always great talking to you. Thank you very much indeed. Carl Shamata, the one and only Chief Market Strategist at Corpay. Coming up, we'll check out some of today's notable analyst calls, including a downgrade on IA Financial, and that stock dropping about 10% today. Okay, let's check out a couple of today's analyst calls. IA Financial, the financial services player, getting a downgrade at Scotiabank, going down to sector perform from outperform with an unchanged price target of $188. Scotia saying the company's Q4 results were underwhelming relative to peers and well below consensus. Scotia warns that the stock will remain under pressure in the absence of any near-term catalysts. Now, core earnings apparently steady in the latest quarter for the insurer, but there was a decline of about 17% in fourth quarter net profit. The company spending heavily, $300 million on acquisitions and share buybacks, but they did beat their 2027 profitability target 2 quarters ahead of schedule. Okay, so that's stock down today. RB Global, the auction stock, getting a price target raised to $140 from $135. BMO sticking with an outperform rating. Analysts saying that RB Global delivered another strong quarter with gross transaction value growth, driving profitability, and that it looks well positioned to win additional market share in the auto salvage business. And B. Riley cutting its price target on TripAdvisor to $13 US from $18 and staying at a neutral rating. The analyst saying that TripAdvisor's legacy hotel and other segment face ongoing pressures, while a competitor called Get Your Guide is challenging the company, leaving uncertainty around narrowing the gap. The analyst says that a possible proxy fight here with dissatisfied investor Starboard Value could create near-term distraction. So TripAdvisor, the stock holding its own today, but B. Riley more pessimistic about the company. Up next, we're going to be joined by the new head of YouTube Canada as that giant Alphabet property bids for domination globally in viewing, challenging Netflix and everybody else in the TV and video business. We'll be right back with Nicole Bell. Okay, so Canada and the global entertainment landscape have been transformed in the past year. AI is just the latest sweeping trend. YouTube is now apparently the biggest streaming channel in the United States, and it's challenging Netflix for dominance and, of course, threatening to hollow out the regular TV industry and cable viewers. Let's get more from Nicole Bell. She's the new head of YouTube Canada. YouTube, of course, a unit of Alphabet. Nicole, thank you very much indeed for joining us.
Thank you so much for having me, Andrew.
So just remind us, YouTube, of course, belovedly, the famous cat videos and homemade content. You've moved a long way beyond that. Tell us, what are the main things you're doing these days?
We certainly have come a long way from, the cats on skateboards of our earlier years. And YouTube is now, we just announced yesterday for the 3rd year running the largest streaming platform in the United States. And in Canada, we have 98% of Canadians are watching YouTube monthly. So, wow. A really tremendous opportunity for creatives to come and tell their stories. And really, a place for shockingly high quality content.
Tell us about your original content, because I was interested to read about this ASAP Science. It's a YouTube channel created by Mitchell Moffat and Gregory Brown. And they are, one of their goals here was to just improve the science of the image of science among gay young people. It's pretty big, though, tens of millions of viewers with sometimes songs about science, etc., that can be edgy.
Mitch and Greg are incredible creators, originally educators and scientists who decided that they wanted to, use the platform of YouTube to be able to reach an even wider audience. They've built an extraordinary studio in Toronto and have a team of folks that work with them now. And as you say, reaching, billions of people around the world. I think, they were one of the key voices. If people remember, the controversy around the dress, was it gold or was it blue?
Yeah.
That was one of their big viral hits. But they continue to this day to draw a really, really strong viewership.
And then, of course, Lily Singh, she grew up not far from here in Scarborough. She rose to fame in part because of her YouTube videos.
Absolutely, yes. Lily was an early breakout star and continues obviously to be a household name in Canada. And I think what's really interesting is, that pipeline of, sort of what I would call the startups of Hollywood or the startups of the entertainment industry that then go on to build these, powerhouse new media businesses. That is still happening with Canadian channels on YouTube every day.
Now, I go to YouTube sometimes, I want to watch a movie, and I can pay to rent the film. Is that kind of paid for content a big part of the revenue stream?
That is a growing part of our revenue stream, both our subscription business and, those kinds of services that we call primetime channels, where you're able to go in and, select a video or a series that you want to watch. That's a growing part of the business. But, overall, I would say still a business that is predominantly advertising driven.
Right, and so that's the thing. I mean, most of the content is free, but you have to sit through an ad. Isn't it interesting, though, just the rise? You said YouTube is now the biggest streaming platform in the U.S.?
Yes, for 3 years running, the biggest streaming platform in the United States, so capturing more viewership than Netflix, Disney Plus, et cetera. And one of the things that we increasingly find is that the largest growth of viewership for YouTube is actually on people's television screens. So what we're finding now is, as families sit down and turn on the TV, what they're turning on is YouTube.
But you still aren't making high-quality dramatic content like Apple or Prime or Netflix. That's not a step you've taken yet.
Well, the difference for YouTube is that we're not a service that commissions content. And so we're not going out and sort of looking for the latest dramatic series and picking winners and losers in the content business. YouTube is a business where you as a creative get to greenlight yourself and greenlight your own idea. YouTube provides you with all of the tools and resources and the ability to find that global audience, which Canadian content does so well. It's really borderless IP. From that, you're seeing tons of channels that are able to grab a gigantic audience and deliver a truly high quality experience. If you think about today, a lot of the largest talk shows, for example, are actually taking place on YouTube, whether that's, something like Chicken Shop Date with Amelia de Moldenhart. Those are landing huge interviews with massive stars. Same thing for giant podcasts, all happening on our platform.
That's interesting, but shows like that, you're not financing them? Are you paying for the production?
We don't, but the way that works on YouTube is, for every dollar that we bring in revenue through advertising or, premium subscription sales, 50 cents of that dollar goes back out to the creator that made the content. And so it really is a way for, creative people to be able to build a thriving and sustainable creative business for the long term, which is what you're seeing when you talk about channels like ASAP Science that have been able to do it for a decade.
You mentioned ads, and of course there's controversy, not just about you, Instagram, other channels, about these fraud ads, these spam ads, and worse, actual fraudulent ads. Why can't you keep those off the channel?
That is a really, really big priority for us at YouTube. Obviously, that kind of content is very much against our policies, and we take it down very, very quickly. It's something that we tackle every single day with a combination of both machine learning and human intervention, and something that we've poured a ton of resource into. It's not something that we want people to be finding on our platform.
But how seriously do you take it? The ads are still there.
I think we do a pretty good job of tackling it. This is an emerging threat area, and certainly one that, we've invested the resources to be able to develop new kinds of AI, new kinds of machine learning to be able to find it much more quickly and remove. And I think, you're seeing a huge difference in the way that YouTube tackles those problems versus some of the other platforms.
But the ads are still there. You could check the ads before you run them, but you don't bother because it would be too hard on your profit, I guess.
Not true. I think, the way that it works on YouTube is that you do have to be approved as an advertiser. And if we see somebody who's abusing our systems that way, we, remove their advertising account and they're not able to advertise anymore.
But still, the stuff gets up there. I mean, it's like a newspaper that was running fraud ads. It'd be pretty quickly kicked out. But you guys, the problem persists.
I'm not sure that it persists to the degree that you're suggesting. I think that we do a pretty great job of taking that stuff down. I think that these are systems that, people are trying to attack on a regular basis. We see, different forms of abuse from different kinds of, bad actors. But it's something that, obviously at YouTube scale, we put a ton of investment into. It's certainly not the environment that we want our advertisers to be in, and not one that we want our creators to be in either.
Right. It's not unique to you. I mean, it'll show up on Instagram and other platforms for sure. Nicole, thank you very much indeed.
Thanks so much.
Nicole Bell, head of YouTube Canada. Coming up, is it a time to buy software stocks, or should you just steer clear of them? We'll get some ideas after this. Shares in Northern Dynasty plunging today after the U.S. Justice Department said it's upholding a previously imposed veto on mining at the company's gigantic Pebble copper and gold deposit in Alaska. Alaskans, and many of them have been fighting that project for years because of fears it would damage crucial salmon habitat. GM Canada is investing an additional $63 million in its Oshawa, Ontario assembly plant. This move is for next generation full-size truck production will upgrade operations and enhance the service parts business. The Oshawa plant currently builds Chevrolet Silverado light and heavy-duty full-size pickups, and it's GM's only North American facility producing both models on the same line. The Canadian housing market saw prices and sales continue to drop in January. The benchmark home price fell by almost a full percent and now sits at just over $665,000, the lowest level in nearly 5 years. The Canadian Real Estate Association says cold weather may have been a driving factor between the latest drop rather than an actual decline in demand. TSX higher today. Gold has been up, so that always tends to help our market. And we have seen strength in oil as well. Just looking at the big traders right now in Toronto by $1 value. Shopify is up at $9. There's been generally a rally in tech south of the border, so that's a 6% rise for Shopify, and Nico Eagle jumping more than 3%. And there's a look at the US market, and you can see stocks higher south of the border. Shares in Palo Alto Networks came under pressure today. The third quarter forecast missing expectations. And of course, the software sector in general has been hammered amid fears that artificial intelligence will change the business of software and services radically. Let's get more from Matthew Tuttle, CEO and Chief Investment Officer at Tuttle Capital Management. Matthew, thanks very much for joining us. Maybe we could put up a 5-year chart for Palo Alto. At one stage, I think investors thought, well, they're the industry leader, cybersecurity, the needs only growing. How could you go wrong?
Yeah, and we're big believers in cybersecurity. We like CrowdStrike a lot better than we like Palo Alto. So we run one of our ETFs, MEMY, is our 20 top thematic ideas, and CrowdStrike is one of those names. All of cyber has kind of gotten thrown out with the bathwater in the software sell-off. but we really see cybersecurity as an area that's going to get increased demand from AI, and certainly you're going to need it if quantum fulfills those promises. So, we would definitely be buying CrowdStrike.
Palo Alto and CrowdStrike?
Well, CrowdStrike is our favorite.
Oh, okay.
I do like the cybersecurity area. So Palo Alto, certainly I wouldn't mind buying on weakness, but CrowdStrike is our favorite in this area.
It too is down. Why is that? Why have investors gone cooler on these cybersecurity giants?
Yeah, and it's really what's happening across software. So last year was the AI rising tide lifted all boats in technology. Then all of those names got extended. Now all of a sudden people are realizing, wait, there are companies that are probably going to get helped by AI, but then there are companies that are going to get crushed. And the initial reaction was sell everything in software. So that's why cybersecurity, Palo Alto, CrowdStrike, all of those names sold off. We think this is an opportunity. We'd be buying some of those names, but then some we would definitely be avoiding.
Let's get into those. DocuSign, you're not keen on that one. It was a darling during the pandemic.
DocuSign is a lifesaver for me today, but it's one of those stocks that I think once agentic AI fully comes online, it's going to be very easy for them to integrate what DocuSign brings to the table into that workflow. So that would be a name that I would not want to own here.
Right. So you basically feel it can be automated by AI?
Yeah, I mean, there are some companies that have sold off in this because of the AI fear that I think is warranted. DocuSign is definitely one of them.
What about Monday.com, MNDY on NASDAQ? Again, you're not too keen on that one.
No, I mean, anything that's got, some sort of workflow app to it that agentic AI could fairly easily incorporate, we would be avoiding those names. We do think those are names that are likely to get hurt as AI and agentic AI comes more on board. So we would be avoiding those as well.
And then finally, EPAM, a stock I'm not familiar with, symbol is EPAM. Can you remind us what they do and why you're less keen on this one as well?
Yeah, I mean, so anything IT services, outsourcing, that's something I definitely would avoid. So that includes an EPAM. And I see that every day. We do have an outsourced IT provider for our company. I'm increasingly using AI more and more for basically doing our IT work. And I can foresee, and hopefully they're not listening, a time where we replace them with AI. So, anything outsourced IT, anything outsourcing, I think AI and agentic AI can take that over.
Talk to us about Snowflake, SNOW. You feel that they're less vulnerable. Why is that?
I feel that they're less vulnerable. So, we kind of spread this out. What are the toll booth companies? The companies that live somewhere along the chain of agentic AI, where, how things are going to happen. Snowflake, it's not a company that we own personally in client portfolios or in our ETFs, but I certainly would not be averse to buying the dip here. We think they are one of the AI toll booth companies.
What about the giants such as Microsoft? I don't know if that's a stock you cover, or MSFT.
Oh, yeah. So no, one of our ETFs is MAGO. It's the MAG 7. I think the MAG 7, if you look at all of the themes, and we teach people this in thematic investing, the MAG 7, one or more of those companies are the obvious winners in a lot of this. Microsoft is a behemoth. Anytime you can get Microsoft on a dip, I would be buying Microsoft.
Right. Stock down a lot this year. Would you be putting new money into it then?
I would be putting new money into Microsoft. And really, we look at whenever people tell you the Mag 7 is dead and it's going to be the other 493 companies in the S&P, that's when I want to buy the Mag 7.
Okay. Maximum pessimism. Thank you very much, Matthew. I really appreciate it.
Thank you.
Matthew Tuttle, CEO and Chief Investment Officer at Tuttle Capital and Management. Coming up, hot picks. We zero in on 3 big caps with dividends. That's ahead. On Hot Picks today, we are drilling in on software as part of a broader look at 3 large caps with dividends. Let's start off with Microsoft. It's a top selection of our guest, Don Nesbitt, Portfolio Manager at Emerald Advisors. Thanks very much indeed for coming on, Don.
Hi, thanks for having me. And yes, I just heard on your previous guest talking about software and Microsoft. So we talk about how the whole software sector has just been decimated by the concerns over AI. But we think Microsoft is going to actually be a benefactor of the whole AI movement. It's going to help enhance their products. So externally for their products, it should be a great selling point. And internally too, it's helping the company, like many others, become more efficient. So I think your previous guest also mentioned there's going to be winners and losers in this space. Software, because of its size, its dominance, its large customer base, we think that it's going to be a winner.
Why has Microsoft dropped so much this year? It's down more than 15%.
Yeah, great question. And it all began after about 2 quarters ago when they announced their earnings. And they had a strong earnings beat, strong revenue beat, which is, by the way, what we look for in stocks. However, the expectations built around it were just disappointing. It was kind of funny, and it centered, I believe, on its Azure cloud and the fact that it only grew at 39% instead of 40% that the street was looking. And that seemed to kind of kick off the whole downward spiral that we've seen over the last 6 months or so.
So just a marginal slip on the Azure growth was a crucial reason for the drop, do you think?
Yeah, that seemed to be the thing, because otherwise they had a pretty stellar report. Same thing with the most recent quarter, another good quarter. But once momentum gets going, momentum's a strong factor, and it can build on itself. And we've seen that in the whole sector here with software, where it's starting to, it's literally had a bear market. Microsoft itself is off more than 25% off its highs.
You say that the multiple, it's not guaranteed that investors will be willing to pay the current or a higher multiple for the stock. Partly, one of the questions here is whether cloud monetization will come through for them. What do you mean by that? Actual profits from their cloud hosting?
Correct. Obviously, all these AI innovations, tech in general, it has to come through in the bottom line's earnings. Now, the interesting thing about Microsoft, I think it's selling at something like 20 times forward or 25 times forward earnings. But where it's really strong is its price to cash flow, which is about 18 times. So Microsoft is a very strong cash flow generator. Compare that to somebody, what has been a recent market darling, NVIDIA. NVIDIA sells for something like 55 times its cash flow.
Let's get on to a name in pharma, AbbVie. Now, one of their huge products has been Humira, used to treat autoimmune conditions. But, of course, they have other medications. What do you like about AbbVie, broadly speaking?
Yeah, of course, Humira, they lost their exclusivity there, but they've been replacing it with other products. They've got a strong pipeline. Kind of continuing on with this AI theme, the healthcare sector in general is going to benefit greatly from AI. And unlike some of the other things we've seen, with the software, with, for example, wealth management, the insurance industry, all these, some real estate management, these industries that got beaten up last week over AI concerns. AI is going to be a big help and developer to the pharmaceutical industry. And not only on their side, but also the FDA is using AI to help streamline and process the regulation and the approval of these drugs. So the whole industry should develop, or should benefit from the AI movement.
It's going to be interesting. I guess things like checking side effects, they'll be able to find, is there correlations to lifestyle or genetics?
Exactly. I mean, AI is going to be a real big contributor to them. And again, not only on the products they sell, and but on the operating efficiencies and developing these drugs and so forth. It's obviously a very data-intensive industry, and it can benefit from AI.
And they've been a pretty steady dividend grower over the past few years, and the yield not too shabby, 3%.
Exactly, and this is the kind of stock we like to own. What we call a dividend grower. By the way, Microsoft would also be characterized as a dividend grower. It doesn't have much of a yield at 90 basis points, but it's growing. And Abby is in the same situation here. It's been a very good performer for us in our dividend portfolio strategy.
And just finally, PNC Financial, we're a bit tight for time, a huge U.S. lender.
Sure. Super regional that continues to grow and is taking on a national presence. Again, they're benefiting from AI. I think and the bottom line and for the fourth quarter earnings, they said it added 30 points to their profit margins and expect it to continue to grow as they use it to, again, operate more efficiently.
Of course, investors love banks, don't they? Banks traditionally woo shareholders with dividends.
Yes. Yeah, it's a good point. The banking sector has been a very strong dividend growing area of the market.
Where do you come down on the great dividend versus share buyback debate?
Yeah, theoretically they're equal, but if a company raises its dividend, because that should be maintained, that basically sends a message to us of higher quality. So a buyback can happen at any time, and it's a one-time event. But dividends, companies do not like to cut dividends because that's viewed poorly. So if they're able to raise dividends as opposed to a buyback, that instills a vote of confidence for us.
Thank you very much. Really appreciate it.
Thank you for having me, and have a great day.
You too. Okay. After this, we're going to look at U.S. trade policy potentially pushing Mexico and Canada together. These are two of the biggest trading partners in the horizon. In the hemisphere, I'm sorry. What's at stake here? That's ahead. Canada is moving to strengthen trade with Mexico, just reached a new trade understanding, and a major Canadian business delegation visited the country. But what's next for bilateral trade as we move towards renegotiating CUSMA, the overall trade deal, North American Pact, with an unpredictable Washington? We got perspective from Shauna Hemingway, a former diplomat and now senior special advisor for Mexico and the Americas with the Business Council of Canada.
It solidifies what has been a long-standing relationship that really the Business Council of Canada has invested in over, I'd say, the last 5 to 8 years. We're really seeing the opportunity and engaging with our counterpart, which is the Coordinating Council for Business in Mexico. And so under this MOU, we'll strengthen those business-to-business ties. We have already a CEO dialogue that has been well underway. And I think what we're seeing this year is an opportunity to ensure we have that public-private sector collaboration that will be critical in terms of building our collaboration going forward.
What is the framework for trade between Canada and Mexico? We don't talk about it as much as we talk about the framework between Canada and the U.S. Like, is most of it under CUSMA?
A lot of our trade, of course, happens under CUSMA. We saw an enormous growth after we signed NAFTA. So by 12-fold, we grew our two-way merchandise trade over this time. And what we've also seen is a huge influx of Canadian investment into strategic sectors in Mexico, where, strengthening the North America competitiveness in terms of other regions. What we're still waiting to see a bit more growth in is in terms of Canadian exports to Mexico. And also, there's an opportunity this year, I think in particular, for us to bring up Mexican investors and have Mexican capital taking advantage of some of the changes and some of the shifts we'll see in Canada that will make us a more competitive and compelling investment environment.
Yeah, because it'd be interesting to see it because you're in Mexico from that standpoint, right? Like, what's the appetite there for greater trade with Canada?
I think Mexico has been looking to capture Canada's attention and to capture the attention of the business sector in Canada for many years. It's been growing incrementally, but what we need to do is really up our game this year and start to take a much more sophisticated look at the Mexican market. So the Mexican companies here are keen to engage. What we've seen as well from the Mexican government is a great deal of interest in establishing consistent and maintaining a dialogue with Canadian business. So we've had excellent opportunities to engage with the Sheinbaum government since she took office in October of 2024, and it's just been growing. And I think this year we should see a lot of the fruits of our labor paying off to the benefit of both countries.
What do Mexican businesses see as some of the greatest challenges and also opportunities when it comes to trading more with Canada?
They want to deepen the relationship. I think one of the biggest things we need to overcome is a lack of understanding. We have had this tendency to see each other through the lens of the United States and North America, which remains very relevant and certainly critical to both our futures. But we need to start to have a strategy for each other that really takes advantage of all the opportunities that still remain for us to invest in and look at. And what this will do is strengthen our North American competitiveness. So by Mexico and Canada putting a lot of investment into our bilateral pillar, we'll be able to create a North America that's much more dynamic, much more ready to compete with the world in 2026 and beyond.
And you said earlier that one thing that would be helpful to see is more exports from Canada to Mexico. Are there certain sectors that you think could be exporting more?
Absolutely. A couple of the sectors we have down here this week, in fact, includes agri-food, which is always very, very big. The Mexican government is looking to find quality, more affordable options. And of course, Canada can provide that. We have a very dynamic and interesting agri-food sector and agri-tech as well. Advanced manufacturing is a lot of our investment as well in Mexico. But in terms of communications technology, as well as some of the key sectors, for instance, in energy. So Mexico relies on the United States for 70% or more of its natural gas, and Canada can be a second source to sort of bolster that up. So we're looking to export more energy products, and as well, they need to increase their storage here. So right now they only have 2 or 3 days worth of storage, which is a vulnerability to their population, but also a vulnerability to business and investors. So Canada can provide some of that technology in terms of energy storage, and I think that we'll see a great area for growth going forward.
Okay, so just lastly, because we have this MOU today, we know a few hundred Canadian business leaders went to Mexico as part of this delegation. How optimistic are you that we'll see movement from this MOU?
I think we're already seeing movement, and I'm sure we'll start to see even more results. And then just in the next few months, as companies, they've been reporting back that they've had excellent meetings. A couple of companies have already said they've made plans to bring Canadian investors up to Canada as a result of this mission. So I don't think it'll take long. And certainly Trade Secretary Marcelo Ebrard has announced that they're looking to bring a delegation up to Canada as well. So that will be happening later this year, we hope.
Shauna Hemingway of the Business Council of Canada. Thank you very much indeed for watching The Open. Morning Markets coming your way next.